Hey guys, and welcome back to the channel. In today's video, I'll be introducing you to the concept of looking for multiple rejections of an area before entering the market. Of course, with that, when to avoid entering the market. So without further ado, let's get into today's video. Before we start looking at multiple rejections of an area, a good place to start would be actually looking at what a rejection is. A rejection of an area is simple to spot. It's a generally see price approach a key level of structure, and then, if the level of structure holds, price will reverse and move away from the area of structure in the form of a rejection. Let's head over to TradingView and take a look at an example.
We can see here price has climbed to reach this level of resistance, and then has failed to break through this level, resulting in price heading in the opposite direction. The strength of the rejection is typically signalled by the length of the candle's wick. In this case here, the rejection is weak, showing as price came back to the area pretty quickly. But in this case, the rejection is stronger, indicated by the wicks, and price continued down further away from this level.
The reason we like to look for rejection in an area, which as we see, usually signified by price actions such as pin bars or engulfing candles, is that we always want to look for signs that level is holding in order to increase the probability of our trade working and ultimately going on to hit our target. It's also super important to consider the bigger picture when looking for trades based around rejections of a level of structure. If price in the high time frames in a clear uptrend and you've decided to enter based on a rejection of an area of resistance, it's pretty likely it'll just be steamrolled as price continues straight through that level. The reason for this is that if price is in an uptrend, a level of resistance on the smaller time frames probably won't mean that much, and price will just follow the dominant trend. The way that you can use rejections to follow the trend is watching for a pullback of the dominant trend to an area structure, then capitalising on the trend continuation. Let's jump over to TradingView again and take a look at another example.
Here we can see price coming quickly into this level, but has formed a level of resistance. However, the rejection here is very weak, and price soon breaks this level and uses it as support. You have two opportunities to enter on the pullback, the first touch here, or the second touch here. Following this, price continues in the direction of the dominant trend.
Another important indicator of a rejection of an area is considering the strength of rejection of that area. For example, if price swings into an area and then swings violently away from it, it's likely to be a stronger rejection than if price hangs around the area for a while and then only rejects the small amount. Let's jump out of TradingView as this is quite hard to visualise but we haven't got a chart in front of us.
Here we can see two rejections on the screen which are circled. As we can see, price has moved quickly into this level, finishes with a much smaller candle body at the top of the swing, and then falls with strong momentum from this area. Price moved quickly away with momentum, which is a good indication of a strong rejection. On the next swing, price stalls much earlier, indicated by the middle doji. Price then hangs around at this level with a few rejection candles, but not really moving away. We then have a small rejection before price swings back up with momentum and likely triggers your stop loss if you went short here.
Price returning to an area of support and resistance is one of the most misunderstood concepts that retail traders often have. Usually most retail traders think it's good if a level's had 7 or 8 touches and that this is going to be stronger than one that's had 1 or 2. But in reality, more touches or more rejections of a level doesn't actually necessarily mean that the level is going to be stronger. To examine this further, what we need to do is return our discussion to ranging versus trending markets. If we're in a trending market, multiple touches or rejections of a level tends to mean something completely different when compared to a ranging market. To examine this fully, let's examine our diagram.
Here we can see price rejecting a level of resistance multiple times, and the traditional retail traders may see this as a surefire level to sell at, as it must be a strong level if it's rejected 3 times already. However, as the 200 EMA suggests, we're actually in a strong uptrend currently. As we know from previous episodes, we want to be in line with the trend, so we shouldn't be looking for sell positions here, only waiting for buy positions. Another thing to note is that the rejections are far from being strong, with price only moving a little bit away and returning to the area very quickly. If we now look at what transpires, you can see that price indeed doesn't sell off, and instead breaks through resistance and then carries in the direction of the dominant move. The best way to trade this example would be to use an area of structure as an inverse level. As we know, the level was previously resistance, but as price is now above the level, we can use it as support and pivot along from here with our stop losses below the support.
Now with that understood, let's check out what happens in a ranging market. In a ranging market where price is moving within a channel and bouncing from side to side, more rejections of an area may actually make a level stronger and essentially make a stronger channel. However, it's important to remember that ranging markets do have to break at some point, so as buying at support and selling at resistance may work for a while, it obviously won't work forever. When trading in ranging markets, it's important to remember that Wyckoff schematic, in that there will likely be a grab for liquidity by one of the sides dropping first and then price heading directly up in the opposite direction. So again, let's jump on a trading view and take a look at that.
As you can see on this example, we're quite clearly in a range, with multiple swing highs and swing lows. Those with keen eyes will also quickly spot the grabs for liquidity, indicated by the long wicks and candles just breaching the borders of the range, before moving quickly back inside of it. As we know, the range does need a break at some point, and as you can see, it finally does. Another thing to note is that, as we discussed earlier, you can wait until a level breaks and enter on the pullback for a more conservative entry. As you can see, price does indeed return to this level to test it as resistance, before falling away with strong momentum to the downside.
That's about all for today, guys. I hope you enjoyed this video as much as I enjoyed making it. And if you did, be sure to smash that like and subscribe button. And maybe you can let us know your thoughts in the comment section down below. For that being said, guys, cheers, and I will see you in the next one.